it's hard when you're in a market to know, am I at the peak? Am I at the bottom? And then to have the ability to move. So yes, if we could do that in the real estate market in Sacramento, that would be the ideal play. If you could ever time the market, be it the real estate market or stock market, I think everybody, if you could do that, which sounds great in theory, but it's not really possible in reality, you could probably get a better return, right, by selling at the very, very peak, taking your chips off the table, and then the market crashed. You could have bought assets for almost half of what they were at the peak. Yes, if I could in a perfect world, if I could do that. But here's the flip side of that. I live in reality, and it's really hard when you're in the market to know, is it the peak or not? Look at what we just went through with COVID. At the moment that hit in spring, a lot of people were going, wow, this is going to be a really, really big challenge. And yet what happened in some sectors, particularly on the residential side, prices were on a tear. So it's hard when you're in a market to know, am I at the peak? Am I at the bottom? And then to have the ability to move. So yes, if we could do that in the real estate market in Sacramento, that would be the ideal play. It's same thing with the stock market. If you can perfectly sell your stock. I mean, gosh, Brett, I once bought a stock that went up 40 times in value, but I never sold it. And it went right back to what I paid for it. So literally on paper, if I would have perfectly sold it, I would have crushed it. But I wrote it up and then I wrote it all the way back down. Why? Because I'm an investor, and you always think things are going to come back over time one way or the other. And we don't have all the information. We don't have the benefit of being able to look back. But I'll go with you on that. I'll say if you could perfectly time the Sacramento market, absolutely. But the one piece I'll give you, one data point. What about a diversified portfolio? So you're assuming someone in Sacramento. What if I bought in some of these markets that didn't go through as big of a boom or bust? I may not have had quite as much swing on that, So we've got markets now in the country, three states we all know of that are just booming incredibly: Florida, Tennessee, Texas. I don't see those trends in the short term changing. I think some of those economies are bringing in a lot of capital. What do they have in common? They've got zero state taxes, and they've got fairly business-friendly environments. So that's drawing a lot of capital in. So I think some of those trends would maybe what is a better suggestion is for an investor to diversify their commercial investments into maybe 2 or 3 markets. And maybe that'll provide a little bit of protection from some of these cycles. If you're spread out in a few markets, that way you have a market like Sacramento that goes up high and then crashes. Maybe you can insulate yourself and not have the big swings up and down quite as much. That's the thought.